It seems that global free markets are becoming less free by the day, with governments around the world starting to invest in companies that serve their national interests. Under the Trump administration, the US government is doing the same, and the companies it's been investing in have seen their stocks fly thanks to Uncle Sam's backing. So today, we're digging into which companies have seen US government investment, why the US is backing them, how share prices have reacted, which companies could be next, and where all of this leads. My name is Guy, and if you're an investor, this is one video you really need to see. First up though, I'm not a financial advisor and nothing in this video should be considered financial advice. This is educational content to inform you about the US government's strategic investments. So, if that sounds good, hit that like button and let's get into it. So, before we dive into the specific firms seeing US government investment, let's quickly clarify exactly what's going on here. When we say the US government is investing, we mean it's literally been acquiring equity in select companies, or taking equity-like positions using tools like preferred shares and warrants. Historically, arms of the government such as the Department of Commerce and the Department of Defense, or War as it now appears to be, have supported certain firms through grants, loans and purchase commitments, not common stock. But now, the US government is purchasing equity ownership in some of these firms. But why is it doing this? Well, the main policy logic is supply chain security, not just the profits that come alongside. Reduce reliance on competing countries like China, reshore strategic industries, and keep choke points under US control. That is how the White House itself has framed its recent stakes and approvals. So, with that brief overview of the framework and logic out of the way, the next question is which companies have made the cut? Well, let's start with a household name, Intel. On the 22nd of August, the White House said the US would take a near 10% stake in Intel. That meant around 433 million shares at $20.47 apiece, or about $8.9 billion for a roughly 10% position. Now, the stake is passive. That means no board seat, and Intel says the government must generally vote with directors on shareholder matters. The funding came from unpaid CHIPS and Science Act grants. That's a law that subsidizes domestic chip manufacturing, plus money from the Secure Enclave program. But why Intel? Well, there are two big reasons. This investment shored up domestic chip manufacturing and kept Intel's foundry turnaround alive. The administration also presented it as a model for future risk-sharing deals. Trump even said he hopes to strike, quote, many more cases like it. Now, did the market care? It certainly did. Intel stock popped on the initial media reports that Washington might buy in, rising over 7% on the 14th of August. On the announcement day itself, it jumped again. If we measure the move from the time rumours began up until now, Intel stock has rallied by 80%. Although we should mention that this move was also helped by other announcements such as Nvidia's investment in the firm. But in any case, now we have a situation where the US federal balance sheet is taking real exposure to a flagship chip maker in exchange for capacity, jobs, and national security assurances. The documents call it passive, but the message is certainly not. Build strategic tech at home and Washington will meet you halfway. And as far as stock performance goes, well, when Uncle Sam taps into a firm, liquidity follows and big gains can be made. And if you want to get a piece of those stock market gains, then tokenized stocks on exchanges like BitGet offer a fast track for getting exposure. What's more, BitGet's AI assistant, GetAgent, can help you separate signal from the rumours of which firm might be next. If you want to try that out for yourself, hit the BitGet sign-up link in the description below. That link grants you a GetAgent Plus trial, giving you access to GetAgent's advanced features and allowing you to ask up to 10 tailored questions per day. On top of that, you'll get a deposit bonus worth up to $50K USDT. So just hit the link and it'll take you to the BitGet sign-up page with the special code baked into your sign-up. From there, simply create an account using your email, Gmail account, Apple ID, Telegram, or even connecting via a Web3 wallet. And once your account is created, your bonuses are automatically applied and you're good to go. Okay, the next company on the US balance sheet is another big one, MP Materials. In July, the Pentagon cut a public-private deal which could see a 15% stake in MP Materials, the only US producer of rare earths with a fully integrated supply chain. The Defense Department agreed to buy $400 million of MP's new convertible preferred stock and a warrant for extra shares, an equity-style package that can turn Washington into one of MP's largest owners. Why MP? Well, especially with recent headlines on Chinese-US trade, it should be no wonder why the US wants to secure a stake in its rare earth production. Now, notably, magnets are a big feature of this deal. High-performance magnets that go into EV motors, precision missiles, and fighter jets start with rare earth elements such as neodymium and praseodymium. Let's pretend I pronounced those correctly. But the point is that China largely dominates the production of these minerals, and the US doesn't want to be stuck begging for parts if geopolitics go sideways. So this deal is meant to onshore the magnet supply line around MP's Mountain Pass mine and its downstream plants. Now, needless to say, the markets noted this equity stake, and on the day the deal hit, MP ripped more than 45%, its biggest one-day jump ever, as traders realized Uncle Sam wasn't just writing grants anymore, he was taking equity. A bump in price like this is the market repricing both policy risk and policy support. The package also includes a government loan alongside the preferred equity and warrant. And what's more, the deal comes with a price floor mechanism on magnet output and a 10-year contract to take all output from the new plant. That would effectively protect MP against a China-driven price dump. For the firm and other investors, that's a bit like premium supply chain insurance. So this move tells us that Washington is willing to become a direct shareholder where supply chains collide with national security. And additionally, Uncle Sam is willing to put his money where his mouth is and protect that investment with his checkbook. Okay, next up we have another mineral play by the US government, Lithium Americas, a Canadian mining company currently developing the Thacker Pass lithium mine in Nevada. In their own words, they're, quote, powering the US lithium supply chain. On the 1st of October, Lithium Americas announced that the Department of Energy had acquired a 5% stake in the company and another 5% stake in the company's Thacker Pass joint venture with General Motors. These stakes were later folded into a renegotiation of the project's $2.26 billion federal loan. A week prior, Reuters reported the White House was pushing for as much as 10% as part of these loan talks. The final number landed at this 5% plus 5% deal, but the message hit home nonetheless. Washington wants to secure critical mineral supplies. The reason behind choosing Lithium Americas in particular comes down to scale and timing. Thacker Pass is set to be the largest lithium mine in the Western Hemisphere, slated to produce around 40,000 tons a year once Phase 1 is up and running. And keeping things focused on US production, General Motors is lined up to take the initial output. Markets certainly got the message. On the stake chatter alone, Lithium Americas ripped, soaring as much as 90% in a single session as traders priced in a federal backstop and Uncle Sam as a strategic partner. By this stage, Washington had shown a trend of acquiring equity in strategic interests, and the market had gotten the message that government buying is very, very bullish. So, when it comes to the American government acquiring equity stakes, critical minerals and chips are squarely in scope. Also, a willingness to pair equity with loans and other guarantees shifts risk away from the company and towards a shared public-private balance sheet. Deals like these give us some insight into a new regime of state capital brought to you by one of America's most unorthodox presidents yet. Anyway, back to Trump's shopping spree. On the 6th of October, the US bought roughly 10% of Trilogy Metals for $35.6 million, plus warrants that could lift the stake by another 7.5%. In the same breath, the White House approved the 211-mile Ambler Road, an industrial road leading to Alaska's remote Ambler mining district. So that's equity and permits on the same day, about as clear a policy signal as you can get. Why this company? Well, copper, first and foremost. The Ambler mining district holds copper and other critical minerals the US wants more of at home, and the road is the key to reaching them. The approval reverses a Biden-era block that cited risks to wildlife and subsistence hunting, which means the controversy around this project probably isn't going away anytime soon. But markets didn't wait around for any debate. Trilogy shares went vertical, more than tripling on the headlines, as traders priced in federal money, a path to infrastructure, and a potential re-rating of the whole Ambler district. Part of the deal involves Australia's South32 selling a slice of its Trilogy stake to the US Department of Defense/War. However, it leaves South32's 50% interest in Ambler Metals intact. That's a joint venture with Trilogy Metals. In other words, Washington isn't just funding a mine, it's seating itself on Trilogy's cap table alongside an established partner. So, in Trilogy's case, we get a unique glimpse of how impactful a strategic government investment can be for share price. Because the equity acquisition was paired with a green light for key infrastructure that's been argued over for years, bullish animal spirits took over and duly sent the stock soaring. Okay, now, strictly speaking, the final firm on the list isn't a case of the American government buying stock, but it is a case of the government buying control. When Nippon Steel's $14.9 billion takeover of US Steel closed in June, the deal came wrapped in a national security agreement that gives the White House special power via a golden share. How much power are we talking? Well, ultimately, the president controls the golden share. That seat comes with the right to appoint a director and to weigh in on decisions that touch domestic production and competition. That is an unusually hands-on role for Washington in a publicly traded industrial icon. The government can also deny a headquarters move out of Pittsburgh, block shifting jobs overseas, and even stop a name change. There are also guardrails tied to sourcing raw materials, anti-dumping pricing, and certain acquisitions. That is essentially a standing veto on actions that could weaken US steelmaking capacity. And what do you know? It's already been used. In September, the administration invoked the golden share to stop US Steel from shutting production at a plant in Illinois, a clear demonstration that these powers aren't theoretical. Many see this as a precedent. If a politically sensitive takeover wants approval, expect a national security side agreement with strings attached. In other words, America may have just discovered its own version of Europe's golden share strategy, and it might not stop with steel. Now, this isn't an investment in the traditional sense. There's no equity involved. But in practice, a government-held veto over plant closures, jobs, sourcing, and governance can matter just as much as a share count. For markets, it's a clear signal that strategic sectors won't be left to the invisible hand alone. So, Uncle Sam is buying into firms, and these firms' stocks are rallying massively on the back of it. So now the burning question is, which firms are next? Well, as far as which industries, we can probably expect more of the same. That is to say, the government is likely to continue buying into companies that plug strategic gaps in critical minerals and chip makers. So, let's start off with miners. Reuters reported that Washington has kicked the tires on Critical Metals, a US-listed owner of Greenland's Tanbreez project. Shares rallied on the headline that an equity stake was under discussion. However, following that initial report, a White House official poured cold water on the idea. But rumours start for a reason, so this is one to keep on the watch list. Then we have Perpetua Resources, which just got the green light to begin building its Idaho mine after years of review. That positions it as the top potential domestic source of a defense-critical metal that China has squeezed. If Washington keeps leaning into strategic equity, a company already through permitting is therefore an obvious candidate. But it's not just North American-based firms that may see Uncle Sam's dollars next. Recently, the American government offered to buy equity in Australian critical minerals companies as part of a broader funding package to cut China risk. That doesn't mean a deal lands tomorrow, but it means conversations are live and producers with US processing plants have a head start. Australian critical minerals companies visited Washington back in September in large part to gauge the opportunity brewing for US investment. So that's a short list for critical minerals, but what about chips? Well, reports strongly suggest the administration is evaluating equity stakes in other CHIPS Act recipients, not just Intel, though the specifics will vary deal to deal. That puts any US firm in that category into a watch closely bucket. Just remember though, not every firm that receives an award via the CHIPS Act will come with ownership strings attached. GlobalFoundries has told investors its CHIPS framework doesn't involve equity, which is proof that policy is being tailored company by company. So that's the basic approach when looking for which company might be next. The White House will almost certainly keep focusing on key strategic sectors for national security in an increasingly fractured global world. However, picking the right firms ahead of any announcement will be tricky. Thankfully though, based on the stock rallies we've seen so far, you don't have to be particularly early to make sizable returns. So, it's possible we're in a new era where America just keeps buying equity stakes in strategically important companies. So, the obvious question then becomes, how might all of this play out? Well, let's theorize on three basic ways this story can go from here. Scenario 1, successful expansion. The government takes real stakes, factories get built, supply chains move home, and the US ends up with more chips, more magnets, and more critical minerals. Scenario 2, unsuccessful contraction. On the other end of the possibility spectrum, it's possible that politics creeps into day-to-day business decisions, crippling efficiency, scaring off investors, and slowing execution. Scenario 3, the trend simply fades and things just chug along more or less as they have been. Now let's dig a little deeper into the path where things work out swimmingly. The biggest signal here is whether Washington keeps using equity and equity-like tools to speed up build-outs. If that happens, expect more factories on US soil and steadier funding for them. Sprinkle on some price floors which change project economics overnight, and you can see how this turns into an industrial base that isn't whipsawed by China's pricing power. In this scenario, stocks in those pipelines likely continue to re-rate higher because the cash flow risk is lower and timelines are clearer. Now, what about path number 2, where things don't work out so well? The US Steel deal showed that even without buying stock, the government can hold a golden share that acts like a veto. Now, investors hate uncertainty around who calls the shots, and that golden share stirred debate about how far Washington may go. If these kind of controls spread and intensify with more veto rights and more strings attached, you'll likely see fatter policy discounts in equity valuations. Companies get a safety net, sure, but they also get a new boss lurking in the shadows. And finally, the path where things just fade. The government stops its shopping spree and possibly even reverses its equity holdings over time. In that latter scenario, some loans and procurement contracts may linger, but not permanent partial ownership. Markets would then re-rate based on old-fashioned business execution. So, which path is it? Well, so far, the deals struck have been well received by the market. Investors like this trend. The firms seem to like it too. And of course, the White House is vocal about how pleased it is with these deals and developments. So, frankly, there's no reason to believe the optimistic scenario isn't playing out, at least for now. However, if instead we see more golden share style controls with vetoes, we're tilting towards dangerous territory where the US government is meddling too heavily in industry. So, the exact terms of these deals really matter going forward, especially when dealing with key industries such as these. Trump has styled himself as a master of the art of the deal. Let's see if that's true. And well, that's the outlook for now, but which firms do you think might be next to see Uncle Sam as a shareholder? Let us know down in the comments. And if you want to know what's happening over in Europe while America is busy buying up equity stakes in vital companies, then check out this video over here. That's all for now though. As always, thank you for watching and I'll see you next time. This is Guy, over and out.